For successful implementation, I see companies that I work with adopt an integrated thinking approach rather than focusing on the reporting itself. Firstly, there's a need to get buy-in from the top, both at the board level and C-suites. They understood the benefits of adopting the IR framework as it helps them communicate their strategies better, demonstrating how the company is working towards achieving the goals that are aligned to the adopted strategies with short, medium, and long-term targets. It also helps them identify the risks involved in achieving these targets arising from both internal and external environments, and what are some of the opportunities that may present itself to the company during the journey. I recall an example in one of my client engagements where integrated thinking steered the discussion amongst the members of the C-suite at the group level. They truly believe that articulating the sum of the parts in the group will result in more value than by looking at each of the businesses on a standalone basis, and they wanted to figure out how to do that. Secondly, the management needs to spend the time to come together and align their thinking. Whilst this discussion may happen at the board strategy meetings attended by senior management, or management meetings to discuss the business plan for the following financial year, we noticed that the communication on how outcomes delivered by each business unit will build up to the group level targets are not always clear. The result is that business units lack a holistic understanding of how their deliverables will impact one another and how they may leverage each other's strengths to deliver greater business outcomes.
Implementation of integrated reporting in an ideal scenario is driven top-down within the organization, starting with those charged with governance or C-suite and permeated across the organization. To get started, however, the expertise of an external consultant may be of use, provided, however, that the consultant has an appropriate knowledge of the principles of integrated reporting and is able to apply these principles in a pragmatic business and commercial sense within the relevant business and industry context of the organization. Accountancy firms are well placed to assist their clients, subject to independence rules, of course, in incorporating integrated thinking within the organization due to the vast experience and knowledge of the relevant business and industry segments which accountancy firms specialize in. Integrated thinking involves the breaking down of barriers and elimination of silo thinking in strategy implementation. The skills needed for this are well within the ambit of accountancy professionals from the training embodied with the profession.
Strong governance and robust internal controls and processes. For example, there needs to be a clear governance structure in place, controls to ensure integrity of data, owners, reliable system, and infrastructure. It is particularly important to have reliable data that is accurate and complete. There must be also compliance with certain standards, such as Global Reporting Initiative or GRI and Sustainability Accounting Standard Board, SASB. Currently, there are no mandatory requirements for assurance, but having these in place is key, especially if regulators mandate the need for assurance in the future, and with the potential implementation of IFRS sustainability standards. Credibility and trust. Stakeholders can have confidence in the reliability of the reported information, as this helps them, especially investors, make informed decisions. It also helps build and maintain a positive reputation. Risk management by recognizing early warning signs. Inaccuracies or misstatements can lead to the risk of greenwashing and reputational damage. An assurance process ensures robust challenges over the integrity of data reported by management and highlights weaknesses in controls over the related processes. It serves to provide early feedback to senior management and those who are tasked with governance, therefore minimizing the risk of inaccurate reporting.